Dumilan Samunani, welcome back to the Real Streetwise Financial Talk. Once again, this is your boy Calvin, your strap-made investor. And yeah, thank you guys for joining me in another episode where we will continue with our property series, all things property. We started off, if you can remember, with property investment for beginners, just giving you an introduction to the topic in terms of how I started, just gave you a brief overview of my life. And today, I'm going to take it a step further now. We're going to talk about how to choose a property, right? So it's going to be a nice, brief episode, and I hope you enjoy it, guys. So, welcome. So yeah, before we get started, as always, I need to mention, guys, that I'm not a financial advisor, I'm not a financial planner, I'm not an attorney. I'm just a guy that's made his mistakes, that's trying to ensure that you don't make the same mistakes. So everything that I say, everything that I tell you about, just please check it out with your financial advisor, whoever it is that you trust with your finances. And this channel is sponsored by our friends at Click. Check them out, exciting company, doing exciting things. Follow the link, and I promise you there's a lot for you to benefit from there. And yeah, guys, don't forget to hit that subscribe button, share, comment, like, do whatever that needs to be done for us to keep growing this community and learning together and getting as much knowledge out there as possible so that we can grow ourselves, our financial wealth. Diving straight into it. So, if you remember the previous episode, I spoke a lot about defining your strategy within the property space, because that's very key. You need to define your strategy, and I took you through the various strategies that are out there. If you remember, we spoke about flipping, where it's a process of you buy a property with the intention of reselling it, buying to sell pretty much. And we spoke about developments, we spoke about residential developments, commercial developments, spoke about buying to let. So there's various strategies. I wanna focus on one today. I wanna focus on one, which is the one that I pretty much started off on, my partner and I. But with every single strategy, guys, you have to go and do the research, right? You can't just go in there blind. You have to do the research. You need to understand. You need to do the groundwork yourself. Unfortunately, it's one of those things that you just can't pay someone to do for you. The knowledge you need to acquire yourself, right? So we define our strategy. Once we've defined our strategy, us having defined our strategy will then inform where the location is going to be, right? So again, let's choose a strategy, which is the one that I started on. So let's assume the strategy is buy to let, right, with the focus on student accommodation. And what I mean by that is that your intention is to find a property, to buy it, and you want to rent it out for students. So meaning that's pretty much your strategy. You've defined your strategy, you've done your research around it, you've read up on the stats on how many what the bed shortages are within the area or within the nation and all of that. So you've done all of that. You're comfortable with that. You probably went to university yourself, so you're familiar with how it works within the commune space and so forth, right? The next step is now to define the location. So if we've defined our strategy, and we say that our strategy is to buy to let with the focus on student accommodation, it then goes without saying that our location will be in and around a university. So I'll speak about, because I'm from Johannesburg, I still live in Johannesburg, and I went to UJ, University of Johannesburg. That's where I studied. So I was very familiar with the surroundings, or the surrounding neighborhoods, the suburbs around UJ, being your Brixton, your Hurst Hill, your West Dean, your Auckland Park, your Richmond. So I was familiar with that area because I went to school in that area and I was comfortable with it. So goes without saying that I would have chosen that area as my area of investment. So that's exactly what we've done. So you have your strategy, you have your location. The next thing now is to find a property, right? And that can be a scary process, a frustrating process, and that's where you now actually have to commit pretty much, right? Because I promise you, finding the property, especially when you're first starting off, it's not an easy process, right? Because you get overwhelmed by so many platforms. You're like, okay, how do I find a property to actually drive around, searching for sale signs, or do I go on the internet? There's various platforms. Personally, I personally I prefer I back then I preferred, and I still do actually prefer, the internet. Internet has made things easier for us, guys. Gone are the days where you have to drive around, searching for sale signs. You can still do that. I mean, there are people that still do it. I'm just saying it's very easier to do it from your desktop. Just you type in the specifications, you specify exactly, you define what do you call this? There's a filter option in the various platforms that you can use. Your property 24, your private property, and so on. You filter for the exact specifications of the property you're looking for. And once you found that, guys, one of the things that you're going to be concerned about is obviously price, right? Which is the one thing that scares a lot of people off. But the one thing I also want to tell you is that everything is negotiable, guys. The price of the property is negotiable. Nothing is cast in stone. So, and I learned that the hard way. The first property that we bought, we didn't negotiate at all, because we thought whatever price you see on the system or on the computer is set in stone. That's the price that you're going to pay, and that's that you're not going to go negotiate anything. And negotiating is also quite an intimidating process, guys, especially if you've never done it before. But yeah, so we went ahead and we searched for a property. So you'll find your property, but once you find a property and you see what price it's listed at, right, you now have to have a sense of whether or not that price is fair. And one of the best ways to judge whether the price that's listed is fair is to look at other properties that are sold within the area. Again, you can find it on the same platform that you're searching on, right? So you just go to property 24 and you just get a sense of what is the price range of the properties within that area, right? I'll give you an idea. Let's assume we're searching and our defined location has a price range. Like most properties range within the prices of 1 million and 1.5 million, right? 1.5. So if you're now finding a property and it's listed at 2 million, that already gives you an indication that it's a bit overpriced, right? Obviously, there might be other reasons why it's sitting at 2 million. It may be that maybe it's renovated a bit more, or maybe that it has a bigger yard space. There's various reasons why the person would put a higher price. But for me, play within the price ranges of the area that you're looking at, right? Because you don't want to what's the word? You don't want to over offer, if that's the correct term. You don't want to you don't want to buy the property for more than its value, right? So get an idea of the area's market value, and when you're searching and you're looking at the price, just have that as a consideration. Obviously, guys, if you're looking at the price range within the area and it averages between 1 million and 1.5, and you get something for 800, it's probably a bargain. But that's just the first step. So you finding the property online and you're seeing the price is just the first step. Then you'll obviously look out for all the other specifications that you've listed, the number of rooms that you're looking for, whether or not it's got accreditation, because accreditation is a big thing, especially in and around the universities with the student accommodation setup. It's probably easier if you have a property that's accredited. It's not something that would. It's not a train smash if it's not accredited. Like, there's a lot of properties in the area that are not accredited, because as much as accreditation can be a good thing, there are also some cons to it. So you also have to consider that. You need to know your facts. You need to know your information. So the next step is now to go and view the property, which is very key, because you need to know what you're looking for, guys. When we first started off, we were just viewing properties, and we literally we didn't know what we were looking out for, right? For instance, there would be a crack in a wall, and because we had no idea, We had no construction experience or anything like that. We didn't know whether that would be an issue or not, right? There would be issues where there's something wrong with the ceiling, but because you're inexperienced, you wouldn't notice that issue. So my advice is, especially when you're starting off, when you're viewing those properties with the intention of actually buying one, take a person who's experienced within the construction space, more preferably, right? Take a person who understands construction, a person who can, just from looking at something, can tell you this is wrong, or this will give you issues 6 months down the line, or something like that, you know? So, but take an experienced person, a person who understands or what it is that you're trying to do, a person who understands construction, who understands building and all of that, right? Don't take a friend of yours who's just as inexperienced as you are. So you go and you find a property, and then once you are comfortable with what you see and you viewed it and you're comfortable and you're happy with the price range, the next step is then to run the numbers, guys. And this is before you put pen to paper. This is before you talk anything with regards to signing the offer to purchase. You first need to run your numbers. I run my numbers before I actually go and view the property. And what I mean by that is that you'll always hear in property, there's a saying that you make your money going in, right? And a lot of people, inexperienced people in property, think that you make your money going out. And that's not the case. And what do I mean by you make your money going in? When you buying your property, let's assume it's a commune and you're buying that, right? You already know what the price is because it's listed. So you now need to get a sense of the money that you'll be generating from there, right? And with student accommodation, it's slightly easier because you're most likely going to be buying a property that already has tenants in it. So you can already have an indication of how much rental is being generated by that particular property. And what you simply do is you take those cash inflows, the rental that property is currently getting, and you perform a calculation which is taking all those income, dividing by the cost of the property that you're going to purchase, or the purchase price, and the result that you're going to get there is called your ROI, your return on investment, right? So your return on investment, guys, not to scare you off or into or anything like that. It simply means, so when you hear a lot of people talk about ROI, it means return on investment. That's the first thing you need to know. And what that means is that what am I generating out of this investment? And the best way to compare what a return on investment is, think about mawufaka imali in your bank account, in your fixed deposit, and what you get back is interest. They quote your interest rates. They say that if you put so much in, you'll be getting back 6% or 5%, right? That percentage is your return on investment. So that's essentially how much you making for putting the money in the bank, right? So that's the same in property. How you getting to that percentage, that 5% that you'll be earning in the bank, is comparable to the ROI, the return on investment that you'll be making from the calculation I just mentioned. And like I said, the calculation is, well, first of all, there's two types of return on investments that you need to be aware of, right? And depending on the strategy that you're following, you lean more towards the other, right? And the two types are your gross return on investment, your gross ROI, and the second one is your net return on investment, which is your net ROI. So you most likely be concerned with your gross ROI if you are in the buying and selling strategy. So what that means that your intention is to buy with you buying with the intention to resell in a very short space of time. Then you'll most likely be concerned with your gross ROI. But in the buying to let strategy, your main focus will most likely be in the net ROI. And what that means is you take your monthly rental income that you'll be generating from the property, and you minus all your expenses, right, that you'll be incurring as a result of having this property. And the expenses such as your bond repayments, that's the first thing that you're going to be paying, right, from the income which will I. The next one is going to be your rates and taxes. Then you're going to have levies if they are applicable. you're gonna have electricity. So all the costs, including your caretaker, if you have a caretaker that you're gonna be paid, all your costs that you'll be incurring, you minus that, you subtract that from the income that the property is generating, right? And the net effect, right? You then take that amount and you multiply that by 12, because you're most likely going to be generating this income for 12 months. Or you multiply it by the number of months that in a year that you're going to be generating it. So in the student accommodation strategy, you also need to be aware that you might not get 12 months worth of rent, and for a simple reason that varsities mostly start in February and they end in November. So you're most likely going to have January and December vacant. So if you're going to do an ROI for student accommodation, you're most likely going to do it over 10 months as opposed to 12 months. So then you take that, the net amount, you multiply that by the number of months in the year in which you'll be generating it, and that total, you then divide that by the total cost that you incurred to buy the property. And remember, the total cost that you incurred includes attorney fees. So all the attorney fees that you incurred, the actual capital amount, you add that up, and you're dividing the net rental income by that to get your ROI. And the figure that you get from there is can be compared to how much you'd be generating if you were investing your money in a bank. Meaning, if you would be getting 5% if you had invested your money in a bank, and your ROI is sitting at 4%, it means that you would have been better off just putting your money in the bank, because you're now actually comparing apples with apples, right? So you would have been better off just putting your money in the bank and earning 5%, because then you wasted your time. You only, after all that process, after all that work, your ROI is only at 4%, right? On the flip side, if you are getting an ROI of 8% and at the bank you'd be getting 5%, then you're actually better off buying that property than putting your money in the bank, right? There's obviously other factors you'd consider. It's not as vanilla as that, because there's other factors. The fact that you can resell this property at potential profit in the future also plays in the property's favor as opposed to putting your money in the bank. But that's just the way that you run the numbers, guys, before you put pen to paper, before you sign the offer to purchase. Because remember, once you sign the offer to purchase, it essentially means that you've agreed to those terms, irrespective of how the numbers will turn out. You've agreed to the terms and everything, right? So those are the things that you look out for while you're taking a property. So you first find the location. Once you found the location, you go and you search for the property online or whatever platform that you use. You consider the price. You check whether the price is within the same price range. And then once you go and view the property and you're happy that it's all intact, there's nothing that's broken, there's no latent defects that are potentially going to screw you over or anything like that, and you've negotiated the price as much as you can, because that's another thing that you need to do. You need to try negotiate the price as much as you can. I've got a policy or a method, if you want to call it, of always offering at least 30% below what the market price is or what the listed price is. And what I mean by that, if the property has been listed at $1 million, then you just take away 30% out of that. So you put up an offer for, you try buy it for at least 700,000, right? So it's stuff like that you need to consider. And then obviously once you're happy with the price and you've run your numbers, the running of the numbers is the most crucial part, guys, because it tells you up front whether you'll be making cash, whether you'll be cash positive on this deal or not, right? Another important thing to note is that personally, I do not invest in a property that is not cash positive from day one. That's just my strategy. That's just my choice. There are people that invest in properties that are not cash positive on day one because they've got a different strategy. Maybe their strategy is to sell in the very short term and they'll make a profit on a sale. But personally, because my strategy is in holding, I need it to be cash positive from day one. If a property is not cash positive from day one, for me, I don't regard it as an investment, right? And what I mean by that is that if at the end of the month, after sengene imali rent, after sengibhadale wonke ama expenses, I now have to take out from my own pocket to subsidize some of the expenses that the rent couldn't cover, then it's not a good investment for me, because it means I'm paying for it using my own cash. And if you can remember in my previous episodes, I said that the trick here is not to use your own money. Don't use your own cash. Like, if you want to be successful in property, just have the mentality, don't use your own money, right? Let this thing pay for itself. Even when you're buying it, use other people's money in a smart way, obviously, guys. So you run the numbers, you make your money going in, not going out, right? And I promise you guys, if you just maintain those simple principles, cash positive from day one, you will have a very successful career within the property space, guys. Very successful career. And ask any property expert, they'll tell you the same. Cash positive is one of the best things. Like, RI is good. I mean, but you need to remember RI, if you calculating it on a gross method, it can come out to a nice number like 12%, but if you're looking at it from a net perspective, it can be in the negatives. And that too is an indicator that it's not an investment. If your ROI is in the negatives, guys, why are you even investing in it? You know? So yeah, man, that brings us to the end today, where that's pretty much how you choose a property, how you buy a property, right? Remember, you make your money going in property, guys, and that will never change. Doesn't matter where you are, where you are situated, you make your money going in. And how do you do that? By doing or running the numbers up front. Before you put pen to paper, before you commit to anything, before you sign anything, you make your money going in and you run your numbers up front. That brings us to the end of today's session, guys. Thank you once again. Please don't forget to subscribe and click the share button, comment, and I promise you I will get back to your comments. And let's just learn together, guys. Thank you for your opportunity. Once again, this is your boy Calvin, your strap made investor. Till we meet again.